Hey guys, hope you and the families are doing well. We've all been in those trades where potentially it's a breakout or a reversal type trade and the stock starts working for you. It starts moving up. Potentially you've got a gain of 2%, 4%, 6%, but then the stock turns around and stops you out for a loss. It's really frustrating, isn't it? I know I get really annoyed when that happens. So what I'm going to teach you in this video is understanding risk mitigation and free rolling levels. This is very important, I think, especially in those choppy and hostile market environments. Market Surge are today's video sponsor. They're my go-to resource for analyzing company fundamentals. If you're interested in a discounted trial, you'll find a link to that in the description and the comment section below. So let's get into the example here, and I think this is really important stuff to know in your own trading. Free rolling levels, risk mitigation, because oftentimes trading comes down to not how well you can play offense, how well you can play defense. So this here really helps me play fantastic defense knowing these free rolling levels. So I've done a hypothetical example here. Okay, we've got Robinhood loaded up. And let's just say this is a typical kind of flag breakout type pattern. You can see it's kind of building here, high lows, tightening, and then it breaks out for 100. So let's say in this hypothetical example, we take our entry at $100 and we place our initial stop loss at $98. Now, in real life, I would actually set it just underneath that whole number of $98, but for the purpose of this, we'll keep it nice and simple. So our entry is going to be at $100 and our initial stop loss is going to be at 2%, $98, which is also $2 stop loss. Okay, so we have $2 of risk per share that we are buying. Now, to make the math nice and simple, we're just going to go with 12 shares, because then I can show you a half, a third, and a quarter, nice and easy. Okay, so let's say, let me just run you through this and then we'll start breaking it down. And then these scenarios here where we're saying sell a half, sell a third, sell a quarter, I can then point those out on the chart like this. And obviously how I've drawn this, we can see, okay, it's nice, higher lows, higher highs, higher lows, higher highs, higher lows, right? But in a choppy market environment, what you have is, say you have an entry at 100, it pops up to 102, 104, and then it does the old oopsie daisy on you like that, and then you get stopped out down here and you had a gain of 2%, 4%, 6%, and then it does that and you get stopped out down here with a loss of 2%, and you're like tearing your hair out and you're really annoyed about it. Hopefully this risk mitigation stuff may help you and you can think about how you may want to apply it to your own trading. I'm also going to teach you how to use the fib tool, okay, to set these levels up nice and easy on TradingView. Okay, so let's say here, okay, I'm rambling, aren't I? We've got an entry at $100. Okay, we're going to buy 12 shares because the math is nice and easy. So our total position size is going to be $120. That means our total risk on the trade, assuming perfect execution, but both in terms of where we're entering and where we're also getting stopped out, is going to be $24. Why? Because we're buying 12 shares and we have $2 of risk per share. Okay, we're buying at 100. Our stop loss is at $98. 100 minus 98 is 2. Hopefully you're following along. So if we have 12 shares with a $2 stop loss, 12 times 2 is 24. Hopefully that there is nice and easy. Now we get into a little bit of complexity, okay? So what we're going to say is, well, if we sold, if the position moved in our favor, so I'll delineate it, that's a big word, isn't it? I'll delineate it with this, let's make this pink arrow, okay? So nice pink, stands out, okay? So our entry's there at 100, and let's say within the first day it breaks out, it's a really nice breakout, there's volume coming through, yada, right? And it moves from 100 to 102. So we actually have a gain on the position. We're up 2%, we're up $2 as well per share. Interesting, right? So here we could sell half of our position, which is going to be 6 shares. Why is it 6? Well, because 12 shares minus, or 12 shares divided by 2 is 6. So that's going to be half of our position. So we could sell half of our position, which is 6 shares at this 102 level. Okay, now that's going to be 1 times our initial risk. Why? Because our stop loss is at 98, which is a $2 stop loss per share, and we currently have a gain of $2 per share because price has gone from 100 to 102. So if we were to sell 6 shares at 1 times our initial risk, that would be $2 profit per share, which equals $12. Okay, 6 shares times 2 equals $12. But then we have remaining risk, don't we? So we've locked in that profit of $12, but then we have remaining risk of our remaining 6 shares, because we still have half of the position, times by our $2 stop loss, which equals $12. Because when we're up here, in this instance here, so I'm just going to turn this pink as well, so let's just imagine that we are up here. Okay, and what we've done is we've just sold half of our position, which in this instance here, let's say it's 6 shares, and we've sold that at a gain of $2 per share. We're locking in that profit of $12. However, when we're up here, okay, and price is now at 102, well, we still have our remaining shares. We still have those 6 shares. So that's the remaining risk that you see here. Okay, so when we're up here, we still have our stop loss down here. Now, let's not get too fancy in this video and talk about, well, we could then like push our stop loss up here and then we could backstop in a profit and yada, 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 and active risk mitigation. Let's keep it a little bit more simple in this video. Okay, does that make sense there? That we can have locking in that profit there of $12, then that offsets our risk of if price then moves back down here and stops us out down here. So if I just draw that, if price were to then move down here and we were to get stopped out down here on our remaining 6 shares and we then get stopped out at $98, that means we'd have a loss on the remaining 6 shares of $12, but we've already locked in that profit of $12 up there. So you just net out. Okay, now of course you may get some slippage and stuff like that, so you may have kind of a smaller loss down there. Remember, stocks can gap down against you as well. Gap downs do happen. But hopefully that there kind of illustrates the example of number 1 of selling half. So I'll speed it up now a little bit. Okay, let's now go through scenario number 2. Now scenario number 2, so we have our entry right here, and what we're going to do this time is we're going to sell 1/3 of our position at 104. So let me take you through the maths here. So we're going to sell 1/3 of our position, which 1/3 of 12, so you can see why I picked 12, because it's a nice number for dividing it by 2, dividing it by, or in terms of doing halves, and in terms of doing thirds, in terms of doing quarters as well, okay? So what we're going to do here is we're going to sell 1/3 of our position, which is going to be 4 shares, because 4 is 1/3 of 12. That means we are selling, okay, 4 shares at $104, okay, which is going to be 2 times our initial risk. So we have the 4 shares times by the $4 profit per share, which equals 16. Okay, 4 times 4 is 16. Don't want to teach grandma how to suck eggs. But then we have the remaining risk. So if we then think about that scenario when we're up here, okay, great, we've sold 1/3 of our position, which in this instance here is 4 shares, and we have sold those 4 shares at a profit of $4 per share, so that equals $16. However, remember, when we are up here, we still have 8 of our initial 12 shares remaining. They have open risk on them. Why? Because our stop loss is still down here at 98, isn't it? So if price then did this and goes from 104 to 98 and we get stopped out down here, okay, that would then mean our remaining 8 shares, okay, with that $2 risk per share attached to them, would be $16 loss if we were to get stopped out down here. However, remember that we've just locked in a gain of $16 by selling 4 shares at a $4 profit, which was 1/3 of the position at 2 times the initial risk. Are you seeing how this is starting to work and how it can be potentially very effective in your trading? Again, experiment for yourself, figure it out, try it, go bar by bar, practice it. Like, practice it deliberately in a manner and see, do you actually like this free rolling? Does it potentially ease pressure on you as well? For me, I much find it easier to try and sit for that bigger move if I free rolled the position. Okay, if I'm up here, okay, just doing that scenario, let's say I'm up here and I'm at 2 times my initial risk, I find it difficult, not necessarily difficult, I find it extremely frustrating is more accurate if I have a gain of 2 times my initial risk, then stop me out at a loss. I get really, really annoyed by that. Like, I have ADHD, I have some anger issues as well, okay? I get really triggered by that, and then that can put me in a negative frame of mind. So that mistake there, by not free rolling, by not using risk mitigation, that can then compound into future mistakes. Because let's say this happens, okay, and I get stopped out like this down here, so I'm then stopped out down here. How I'm then feeling, and I'm annoyed and I'm frustrated at myself, that can carry into the next trade. Because then potentially I'm revenge trading, or I size something up too big because I want to make back this loss, and then suddenly then I make a mistake and another mistake and another mistake, and it's just then a vicious spiral. So for me, the actual risk mitigation and the free rolling levels really help me just try and stay emotionally more stable in my trading. Maybe you're just some super sane and you don't have emotions, but for me, I'm a human being. I have emotions. Trades can annoy me, trades can make me happy, trades can annoy me. So just trying to keep yourself more stable mentally, I find that beneficial for my trading. Anyway, but maybe you're just some saint or something like that. But hey ho, right, onwards we go. Let me take you through the final scenario. So what we have here, okay, is now we're going to sell 1/4 of our position at 3 times the initial risk. So 1/4 of 12 is 3. So we're going to sell 3 shares up here at 106. So if we're selling 3 shares, which is 1/3 of our position at 106, that then means we have 3 shares times by $6 profit per share, which then equals $18. So if we're selling 3 shares up here from our entry down here at 100, and we are selling those 3 shares at 106, that would be a $6 profit per share for those 3 shares. That means we are locking in $18 profit. However, remember, we have open risk on the remaining 9 shares. Okay, we still have 9 of our 12 shares remaining up here. Okay, we free rolled the trade, which is good. Remember, there can be big gap downs. So again, it's kind of hypothetically free rolling because stocks can do anything. You can have huge gap downs against you. But what we're then saying is, well, our nine shares that we've got left, they still have open risk because our stop loss is still down here. Now, that's a topic for another video, isn't it? If up here you would actually be moving your stop loss up, probably be prudent. I'd probably be moving my stop loss up to at least break even, if not maybe in here as well. Maybe there's a key daily moving average, so something in here, right? But I digress. So what that then means is if price then came back down to here for our remaining 9 shares and they were stopped out at 98, well, on those 9 shares we would have a $2 loss per share. Why? Because we bought them at 100 still, and then we're selling them at 98 when our stop loss gets triggered. So 9 times by $2 loss per share equals $18. But remember, we locked in a profit of $18 up here by selling the 3 shares at a $6 profit per share, being $18. So they net out. See that? So this here is why I think free rolling is really, really, really important, especially when you're in those pop and drop market environments. Because how I've drawn this, okay, this is just nice, okay, it's a breakout, it works, high, low, high, low, right? But what we know is in choppy market environments, that doesn't always happen. And more so the mean is this, it can kind of pop, ooh, drop back down like that, oh, pop, and drop back down like that. So if you're then not free rolling, and you don't know about this risk mitigation, then we can go into active risk mitigation. That's in the blueprint video on the channel, okay? Where you can then be even quicker with the risk mitigation side of things. As Sun Tzu said in The Art of War, invincibility lies in the defense, the possibility of victory in attack. Invincibility lies in the defense, the possibility of victory in attack. How good is your defense? How good is your risk management? Okay, great. Maybe you've learned that you need relatively tight stops. So if you swing trading, potentially your average stop loss is somewhere between 2%, 4%, something like that, okay? But then how good is your risk mitigation? How good are you at free rolling trades? How good are you at putting yourself in a risk-free position? So in this instance here, right, maybe this could pop up in the space of an hour. Like you take a breakout or a reversal and it just go gadget like that. Well, you could go from 100 to 102 very, very quickly, especially if a stock like Hood currently has an ADR of 5.57%. So quite easily that could happen. This would actually indicate that Hood could go from $100 up to 105 pretty easily that day. Why? Because that would be about a 5% move. Makes sense? And the 20-day average daily range percentage is 5.5%. So Hood, in this instance, could do that quite easily. So what that then means is potentially in the first hour of being in the trade or less, if it just push like that, well, what you could do there, sell half of the position, great, got my stop loss down here, I'm risk-free on the trade. I'm risk-free, not the tree. I'm risk-free on the trade, not risk-free on the tree. Let's see what it wants to do. Can it now trend? Go on a big move. Now I've taken the risk out of it. Let's see. Let's find out. Be open-minded to what can happen. Whereas otherwise, if you're then not free rolling and going, oh, it's moved up here. Oh, no, look, I got stopped out again. Oh, look, it's moved. Oh, I got stopped out again. Whereas here, you can go, okay, boom, pushes out like that. I free roll it. I get stopped out. All right, and break even, whatever. Move on to the next trade. See how the mentality, the mindset is very different to then how you're thinking about that situation, but then how you're thinking about future situations as well. So I'm now just completely rambling at the end of the video, but hopefully you guys have found that useful. Oh, one more thing. If you want to use the fib tool, okay, go to TradingView. Find the fib tool, okay? It's over here. It's probably actually off the screen at the minute, but there it is, okay? You want the fib retracement tool, okay? Fib retracement tool. You put it in a favorites bar as well. So I've got the fib retracement tool, okay? Like this. Now, all you need to do is, let me go and click on it. These are the settings that you want for the fib retracement tool, okay? 1 is going to be the entry, okay? 0 is going to be your initial stop loss placement or wherever your stop loss is. 2 is 1 times risk, 3 is 2 times risk, and 4 is 3 times risk. So let me just point those out, okay? So 1 is the entry level, okay? This blue line coming across here. 0 is your stop loss placement, okay? Here, 2, that's going to be 1 times. 3, that's going to be 2 times. 4, that's going to be 3 times. So if I were to just draw this on again, okay, I'm going to put it there, I'm going to put it there, and then going to double click on it. I'm going to go coordinates, I'm going to go 100, and I'm going to go 98 like that. Ping, ping, there it is, all done. And you pick whatever colors you want. Thanks for watching, guys. I hope you enjoyed that video. See you in a future one.